Hello and welcome to the second episode of the Real Estate Macro Podcast. Joining me today is my friend Dylan Clark. Dylan is going to educate us on some alternatives to the common wisdom, I will say. Is that there's a common wisdom in real estate tax that you want to do cost seg and you want to do 1031. And really, it is almost like a golden cow, if you will. It's the third rail. If you don't do that, then there's obviously something wrong with you, or not. I'm about to talk to Dylan about that. Dylan, thank you for joining us on the call. And real quick, before we go too far, Dylan, can you tell me a little bit about your background and how you got into this space where we are today?
Yeah, so I'm actually not even involved in the real estate space as an investor by any means, but where I started was at 14. I started trading in the equity space, got really good at that. Studied financial markets, microeconomics from there. Started up a online community of an education platform at 16, was educating and teaching about 10,000 people at that time. From there, kind of the process I went was some people got it and some people didn't. So the long story short of it is how do I trade for these people to do it? So found out that I needed my RIA license, my Series 65. So at 18, went out and got my Series 65 license. However, I didn't realize that I'm not allowed to have an educational platform like that while under the RIA firm. So I had to shut that down, unfortunately. But picked up a lot of clients through there before I had to shut that down, before the big wigs became wary of what I was doing. And then once that got shut down, did standardized RIA practice, kept learning about business, economics, kept going that route. And then from there, actually recently left that firm. Actually, it's not so recently anymore. It's already October, but left them, started up a hedge fund with a gentleman named Chris Perkins. That is an equity-based hedge fund and we trade derivatives on ETFs. And then also now with a private wealth management firm, RIA, which is more of a multi-level family office CFO that specializes in taxes.
And that last bit is very fascinating. And recently, Dylan, we had a interesting conversation. I, like most investors, really just planned on, okay, if you're going in and you're going to acquire an asset in the real estate space, you're going to want to do cost seg to front load the depreciation. And to my shock and surprise, you had a very strong opinion against that. And I was wondering if you would share with us today why you think that's not necessarily the cat's meow that is made out to be.
Well, there's simply other ways to achieve the same goal without having to go in and get a cost seg expert. One, if you do it wrong, you can severely hurt yourself. So you almost have to go to one of these experts and get it done. But whenever you're cost segging, all you're doing is separating real and personal. The wall is real property, the paint is personal that you painted on the wall. You're separating these out and you depreciate them. The pros of it is you are reducing your income tax from the rental property and you're taking on accelerated depreciation of the asset. The problem with that is it expires in 3 to 5 years. It does run out. After expiration, 100% of your income is taxable now. Also, the tax deductibility that you're able to take is only proportional to the investment you made in that property. So it's not the worst thing in the world by any means. It works. It's great. There's billions of dollars of transactions that do it. It's just not the best thing out there. You are trapped in this endless feedback, because what happens after year, say 5, say you're able to get out to 5. What happens after year 5? You have to go out, you have to buy a new property. You have to invest the cash flow from property 1 into property 2. So that way you're able to then write off and depreciate a new asset. So you're stuck in this treadmill loop and you have zero control over what you're doing. You're stuck forever. There's no out. Or once you do get out, you're now paying taxes on it. So this system only works whenever you're doing these very specific things and you're locked into it for life once you start.
And so, Dylan, you would agree that if you're cost sagging, you're more or less committing to an exit within that 3-year or 5-year period?
I wouldn't. Yes and no. The problem is with, well, this will lead us probably into the next part of our conversation. If you do sell, you now have a capital gains tax exposure, and the only thing people are ever taught about when it comes to capital gains taxes in this world are, at least in the real estate world, is 1031, DSTs, and installment sales. That's all people are taught about. But even those, they don't fix your problem. You still have a problem.
Now that's interesting, Dylan. It feels like to me you have another way in mind, and I was wondering if you could share with us today if you're willing to go there.
I think it's important to cover some other bases first before we get to that.
Okay.
Imagine, if anyone has a piece of paper, just draw, a small building or a small house, and below that, write for sale without capital gains. Now draw an arrow below that, and next to that arrow, write owner loses control of cash. Because the second you do all the things that you're taught to do, you lose control of cash. No matter if you think you do or not, you don't. So from that arrow we drew down, we're going to draw 3 more arrows from there, and those are going to go to 1031, DST, and installment sale. 1031, what are your pros? 0 capital gains. That's it. There's no other pros besides that. However, 1031, you now run into market risk because you have to go into real estate within 45 days?
45 days. That's right. You're under the gun, and the chances are you overpay for an asset under the gun are pretty high. I think it happens more than you want to admit. If you're under 1031, that's your only strategy. The chances are you're fairly decent. You're going to overpay.
Right, and it happens a lot. So not only do you have market risk because you're under 45 days, you also have target asset risk because you're under 45 days. You have to get this money in there, and you still have lost control of your money. You don't have any control. You're under a 45-day window period to find an asset, expose yourself to a lot of market and asset risk, while not even being able to make a free and fair decision that you want to make. If you want to wait 6 months, you don't even have that option. You have 0 control over your capital. So then DSTs. DSTs, for those who don't know, it's basically the money from the sale goes into a third-party custodian, and it's held at a qualified intermediary. And the distributions on that are paid either monthly through yearly, so monthly, quarterly, semi-annually, annually. Now with that, it goes to a third-party custodian, so you still lose control, just like you did in your 1031. With a DST, they have to keep your money pretty safe. So what are they able to do? Well, they're able to hold cash, or maybe a 10-year bond, or twos, whatever they want to pick. They have to pick very safe assets. So now you run into inflation risk. Your money is going to be eroded by sitting in there. You have escrow risk if this third-party custodian goes underwater, embezzles money, runs, and then you're still paying capital gains tax because the money's getting distributed back to you. You're just paying it on each payment, whether it be monthly or annually, opposed to just all at once. So there's some strategies you can work in there with a DST that makes sense. But if you are selling a $10 million portfolio and that's what you're wanting to live on for the next 20 years, so that's what, $500,000 a year. So you're still paying yourself $500,000 a year to live on. What do you accomplish? You're still paying those taxes. You didn't accomplish anything. And then we have installment sales, which are very identical to DSTs, except the buyer is a custodian of seller's money, and then the seller is going to pay the gains or the tax on the gains in that example. So now that we have those broken down, what we do is we use several different concepts, but one of them primarily being, well, there's an income side and then there's a capital gain side of things. For the income side of things, for W-2, we use things somewhat close to tax credits. And then 1099s, K-1s, we utilize a concept that we call a private 401k.
Okay.
Very similarly to the 401k you have at work, except you aren't capped at 21,500 if you're with an employer one. If it's a solo one, I think it's like 58.5 now. But still, you're limited, and even those have income limits. So if you make X amount of dollars a year, you can't have one of those. What we have is a concept utilizing Tax Cuts and Jobs Act 2017, Secure Act, Inflation Reduction Act. All these different tax codes and tax laws that have been put into place over the years have built and created a system that works very effectively to allow you not pay any income tax, put the money in this vehicle, sits in a float similar to a 401k. You're not limited by how much you can put in there per year. You are limited at 10 million on the upside of things. So there is a cap of 10 million that can be in this. But after that, we have other strategies that we'd implement to solve that. At which point you're now on a pre-tax basis. Your growth is on a complete tax-free basis. And then the distributions, even on the back end, we bridge strategies together that we have for both the income tax side and our capital gains side, bridge them together. Boom, we've now just created zero income tax, zero growth tax, zero distribution tax, and distribution/capital gains tax, all in one swoop. And it's beautiful.
And so, Dylan, let's walk through this. Let's say I'm a syndicator and I'm trying to acquire a deal. And so instead of going the cost seg route, I elect to, let's keep it down the fairway with what you're talking about. How would that look different?
Yeah, so without diving into too much detail, how that would look is there would be a partnership arrangement between what we do and what you do. We would come in. All of the investors who want to do it, of course, they're not forced to by any means. If you don't want to do it, don't do it. But those who are interested, host a webinar, host whatever, get everyone who's interested on board. We would come on, live pitch them of sorts and just give them the information. They're free to make their own decision from there. People who say no, awesome. Cut you a check to your deal, go on their way. The people who say yes, we would then step in as sort of a mediary between you and that person. Since they quote unquote opted yes, we have them fill out all of our client information that's required, that we required by law. And we set all of these processes up for them. We set up all the accounts. We do all the tax work. We do all the entity structure work. We do it all. So once that's done, the money sitting in this account, cut you a check from this account, just like they would out of their normal bank account, and you go on your way. With that, we've done all the tax planning. We set these vehicles up. So now, dollar for dollar, your individual's investment into your project is 100% tax deductible against their income. So if they make $200,000 a year and they want to put $100,000 with you, boom, now they only made $100,000 this year. Okay, you did this for me. Now what happens if I give you $200,000? Absolutely, Mr. Investor, your taxable income for this year is zero. So up front, you save them from 30, we'll call it 30 for a round figure number, 30% in taxes off the bat. So if you could structure this in your PPM actually, since you are doing that, 30% saved on taxes, that could hit your pref already. And from gain one with their dollars, you're already making your carried interest split with them. So now you have their money, we cut or they cut you the check from the entity that we have set up for them. You go do your thing just like normal. It's be as if they cut you a check from their bank account directly, and then send back cash or quarterly, monthly distributions from the cash flow of an asset, or you build a development and sell it. Either way, in both events, those are considered capital gains from a passive property. So money comes back into the account. The money's still considered in this float area, so it doesn't have to pay taxes. At which point, either another check is cut to the next one of your deal if you did well and they're happy. Perfect. Go ahead and reinvest that back out there, which is ideally what you have happen. If not, and someone wants to take cash, or take their cash and cash out on some of it or all of it, perfectly fine with us too. You should probably try and talk to them, but perfectly fine with us. Let's start implementing these bridge strategies. Get this capital gains tax down to 0 and no liability on that side of things, and take your money and go on vacation. Do whatever you want with it. See you later.
Dylan, this is fascinating. Now, once you set up this vehicle that's your passives are investing with, would you have to create a new vehicle each time for each project, or could you use the same vehicle for additional subsequent projects?
Oh, that vehicle is now their vehicle forever. They can use. So that's the thing. Someone who would invest in this traditionally, they're going to have to take part of that 1031 if they want, to pay 0 capital gains tax to go into the next project. And they're still locked into real estate. With this, say you make them $1 million and they no longer want real estate. They want to put all their money in the stock market and live on dividends. They want $40K a year to live on, so they go invest $1 million into 4% dividend stock. And with the way this is set up and how it's done, they can, the day they get their check from you, they can go put all their money right into the stock market. So they have that's the most freedom you can possibly have in comparison to what the other options are out there. The seller maintains control. You have distribution control of your capital. You have investment control on your capital. And then, of course, working with us, we come in and we add the tax planning, which is 0 capital gains and 0 taxable distributions.
And Dylan, this might be too complicated to answer here because my gears are turning right now, and they're kind of the steam is starting to roll up. It's kind of working hard right now. Can the GP also use the same vehicle, or does the GP have to be outside the a 401k?
The GP can utilize the exact same thing that their LPs are doing. It's for anybody. Now, where this can get really, I'll add this caveat, where this can get interesting for the GP is, say we're working together, and that we're able to save 30% of capital gains, make it 0. Mm-hmm. When you go find a deal, well, let's switch to the deal side of it. Whenever you are selling a property, say you bought the property for $1 million, you want to cash out with 7. If you want to cash out with 7, you're going to run, reverse taxes on it, see how much you really have to sell it for to walk away with 7. At 30%, you have to sell it for 10. 3 million leaves, you're left with 7 afterwards. So think if you could go to a seller that you found a property of, you go to them and say, hey, love what you've got going on here, love this property, looking to buy it, gonna buy it either way here. Let me introduce you to my partner. Partner comes to us, we all have our meeting and whatnot, and we get him up to the education standpoint to make him realize that he can now save 30% on his capital gains. He now can sell this property to you for $7 million because he's not paying the capital gains tax. He doesn't have to raise it to account for that. So the listing just came from 10 to 7. He's happy because he still got his 7. You're happy because you just got this property for 30% cheaper than what it was listed at. And the world goes on. Everyone's happy. It's a perfect deal. So that's the other side and caveat to this that I don't think people have quite picked up on and realized is possible, but it's something I'm starting to hit on and speak to, because it's very powerful if you can get a property at 30% discount and the seller's still happy about it.
Right.
When was the last time that you had a seller sell for you 30% cheaper than asking?
It's been a long, long time that's been available, I would say.
Yeah.
Although we might be seeing that soon.
Oh, absolutely.
Okay.
You won't be happy. That's the key in that.
That's right. The happiness level was different here. That's right. Okay, Dylan. This sounds really fantastic. I love it. I'm like really fascinated. What is the caveat or a reason why you wouldn't want to do this? And I'm gonna guess it might be costs, but any other, like, what are your limitations by going down this road?
Well, what do you mean by limitations? I think
Well, if I'm not going down, if I'm choosing not to go cost seg and 1031 land, I'm going 401k land, right? That's basically the choice here.
Yeah.
What do you think should be the determining factor of, like, if I were going to choose one or the other, how would you reach that calculation if I'm sitting there trying to weigh them out? What?
I mean, the biggest thing to it is, do you want to be trapped in an endless loop forever, or do you want the freedom to do what you want to do? I actually had a discussion with someone on LinkedIn about this, and they're like, I'm real estate for my entire life. I'm diehard real estate, blah, 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 blah. Lady, you don't know what's going to happen.
That's right.
You're like, not to be morbid, but your entire family could die.
Yeah.
Car accident 6 months from now. You are going to need money to pay for these things. You are not going to be in the best headspace. So who knows how this is going to affect your business. All of these other things that you're not even considering or thinking of. And I feel that most people who are doing this don't even consider it. What happens if something huge happens and you need to drop $1 million on something? You want to pay taxes on it? No, nobody wants to pay the taxes on it, but you're stuck in your little loop here to where you're forced to. By doing what we do, you eliminate that in and of itself. So, I mean, if you are comfortable simply reducing your taxes, you may make them zero by doing cost seg. So I guess if you're happy doing that, you are happy being 100% locked into real estate with no choice other than real estate, with zero exit strategy or exit plan that is worth the paper it's written on, then perfect. Stay with what you're doing. Go ahead. All for you. I don't want to talk to you. If you are interested in the other route, the biggest, I guess, caveat of that would be the price. But with the price, you are maintaining control of your capital. You have distribution control. You have investment control. And you have multi-layer tax planning and a multi-level family office CFO backing you on it. So while, yes, it might be expensive to the $3,000 to $5,000 you pay the cost seg experts, how much of an expert are they really?
Spicy.
Yeah.
All right. Well, Dylan, I really appreciate you walking us through that. Dare we venture off into risk land and shift gears now that we've slayed some tax sacred cows?
I heard some people are mad right now. I know they are, but that's okay.
There is a fair chance their preconceived notions have been altered, possibly.
Yeah,
it did me. I'll be fair to say that it hurt my head a little bit.
It throws everyone for a loop, and that's all right. You can't be mad or upset about the information you didn't know. Sure. It's like, after hearing this, it's and once people come and work with us, it's like, wow, I really didn't know this. I should have known this years ago. And it's like, well, these so-called experts that you're listening to are cookie cutter from the college factory and all took the same exams, all took the same test, all learned the same material. They don't know any different. They're just cookie cutter people.
This is like the difference between wealthy and mega wealth. I feel like it's one of those ultra high end strategies that Main Street generally doesn't get exposure to, and this is an opportunity for Main Street to get in on the fun.
Right. It's just like a hedge fund, all the top rich people have access to hedge funds. Your standard ordinary people don't. It's the same kind of principle.
Yeah.
And it's you mentioned that when I talk to people with $100 million net worth plus, this conversation is way easier to have with them than someone who has 10 million. It's like going back to the old talking with accredited versus non-accredited. It's crazy. Like, not the we'll call them non-accredited for the sake, but the people who are 10 mil less really 100 mil less are so they have sheep wool pulled over their heads about what's possible is essentially what it is. They don't quite understand yet. They have a bit of understanding of what taxes are and how it works and what it does, but they're almost like too afraid to accept that what they're doing isn't 100% right.
This feels like we've introduced another color pill of some sort. I don't know what color it is, but there's blue pill, red pill, and whatever pill this one is. This is indeed a third reality or a third dimension. It feels like almost.
It's not anything business wise. It's just a fact. It's if you go and talk to people, find your people who, this is what we deal with. We had a conversation with a gentleman who's worth 1.3 billion, and him and another partner of his, he's probably worth close to 500 if I had to guesstimate right now. Mm-hmm. And this conversation went super smooth. There was no issues. They had an understanding of what it is. They respected the fact that they weren't going to know all the ins and outs of it, but that it was possible and that it could be done because they have also heard of other individuals doing it. How do you think, Elon Musk and whatnot is paying 0% or 5%? He's not. I doubt he's cost-segging Tesla factory down to zero. He makes too much. So think of it that way.
Oh, man.
Elon Musk isn't cost-segging every single Tesla gigafactory against his income. It's not happening. It's insane to think that this works at a certain level.
A fair probability that it's not going that way, is it?
Right. So it's like it goes back to kind of the non-accredited versus accredited thing. It's like you only are able to do with what you know, but don't be so blind and have such an ego because you have a couple $1 million that you know everything and that everything's going to be great. You're still broke. You really are.
It's like Arkansas, I like to say. It's all relative.
Right. But, what do you, in today's day and age, inflation adjusted, what do you really need to retire? 6 to 7 to be pretty comfortable?
Usually.
Not really have to worry, if I go into a nursing home, am I going to be okay? 6 to 7 million. You can burn through 6 to 7 in a heartbeat. Yeah. It goes quick. It goes a lot quicker than people think. So, it's thinking outside the box, accepting that you're wrong. It's okay to be wrong. You don't always have to be right. Dropping the ego and accepting the facts that are being presented to you as they are. And making a better situation out of it. There's no reason to shut down and say no because you don't agree with it. You don't have to agree with everything. That's life. You're still wrong.
As I am known to be on occasion. It happened like once 10 years ago, I think, or something like that.
I think July of 2006.
I think that's right. Yes. No, and I think what I really appreciate about your comment, and this is a big battle for all entrepreneurs, I think myself especially, and it one way or other, you have to have the ego taken out of you. And what I definitely appreciate about you, Dylan, and I will say this, with in all sincerity, surround yourself by people smarter than you. And Dylan has probably about the twice the IQ than I do. It's a pretty significant improvement by being surrounded by Dylan, because not only we have the tax thing going on, but I would love to pivot into the risk side and the hedge fund stuff, because that, to the extent you can talk about it, I understand you can't get into the weeds necessarily with where you're at and what you're doing, but process wise, and what the lessons so far on raising capital for a hedge fund, for example, and if there's anything in that journey that sounds interesting to talk about or you'd like to talk about.
Truthfully, the biggest thing at this point that is raised capital and that is working to that is networking. So get comfortable with the saying, slow is smooth and smooth is fast. You're not going to raise capital overnight. It's not going to happen that way. You have to build a relationship. Like there's a relationship that's been built for several months now, and they're finally coming around to being on board with it. And it's just accepting that it's not going to happen quick. It's going to take time. It's going to be a fight. Also getting comfortable with the laws of reciprocity when starting up. You've got to give to others before you'll have a single dollar given back to you. So find something that no one else knows, add value, help out, even if it's as simple as being a co-host for a Zoom. Go be their co-host, go help them out. It's hard to run a Zoom with 30, 40, 50 people. It really is.
It is.
Especially once you get into the whole conversation, you have to manage letting people in, whatever it may be. Give back, give to them. They'll come around and help you. People will see you there all the time. Your name's always there. You're always around. People know eventually what you do, and eventually, hopefully, ideally, at some point, you're the person that they think of whenever they want to go to it. Raising capital is a gift in and of itself. It's all sales, is what it is. People I feel come into this game to kind of, they don't quite understand that it's sales, but it's sales. Anything business related is sales.
Right.
Doesn't matter if it's a hedge fund or not. It's all sales. You have to sell. You have to be selling. You have to negotiate. You have to learn how to speak to people, how to control these conversations, how to get the answers you want. Biggest thing, quit trying to get a yes out of them, get a no out of them. It's a lot easier to get a no than it is a yes, and you can frame your questions to get no's.
Yes. Completely agree. And for those of you who have not read the book on that point, I cannot recommend Never Split the Difference any more highly on this point. You learn the value of giving someone their autonomy while asking a question versus a no-oriented question versus a yes-oriented question is night and day different. So completely agree with you on that point.
Yep. And it's little things, is now a bad time? Now's not a bad time, or yes, it is a bad time, but here's when a good time will be. Or are you opposed to doing this? No, I'm not opposed to it. Or yes, I am opposed, but this is why. So by generating the no-oriented questions, you either get the yes that you're looking for, or you get the no that you were previously searching for, but an answer and a reasoning behind it. It shifts the logical thinking for someone, and they're more willing. The easiest path when being pitched to something is saying no. So utilize that path. It's hard for someone to say yes.
Yes.
They're being pitched. They don't even realize they do it.
And completely agree with that. And I love its companion, the calibrated question of what and how questions are very good, because you get someone to think in terms of process and not like forcing them into a box by asking what and how. You get so much data by asking those questions. You really start to get a feel for it. And I don't know if you agree with this on this point or not, but I'm not here to help everyone. So I don't want to waste a bunch of time. If I'm not a good fit, I'd rather find that out sooner than later rather than later.
Yeah, I'd agree. Time is precious, and don't have a whole lot of time to waste on nonsense. My time's better invested elsewhere. You know, I also think that's part of a reason why people struggle and fail is because they try to please everyone. You're not going to please everyone. No one's been able to achieve it. You're not going to be the first. It's not happening. So accepting that fact and being able to just pivot and understand that you're not going to be able to help everyone. It's going to hurt the day that you get your first $1 million investor who you don't even want, to help. You don't. Right. He doesn't really be there. It's not going to feel good because you just missed out on $1 million check. Where if you just kind of switched the conversation and nurtured them a little bit, you could have had $1 million check. But who cares? Go on, move on to the next one. They're not a right fit for you.
Yeah. What if you have that $1 million check, but they love suing everyone? What are the chances are they going to sue you? If they've sued every partner they've ever been with, then what are the chances they're going to sue you? I'd say it's probably fairly high.
Yeah, and I mean this goes into risk parity standpoint and all that stuff, which we can dive into if you want. But actually, that's not a bad topic to get into.
I love risk, and talking about risk, I could do it all day, every day. So yes, let's go there for just a little bit. Yes.
All right, sounds like a plan. Which parts of risk? There's hundreds.
I love the concept of asymmetric risk, and I'd love your thoughts on how to evaluate and ideally set yourself up for asymmetric situations.
Currently Googling asymmetric risk.
And really, I love the concept of basically don't take a bet that you can't get the odds more than, like, if it's a 50-50 odds, you really want where your odds of success are significantly higher than your odds of loss. So you're looking for situations to the extent you can to set yourself up for higher probabilities of winning versus losing out. Is essentially the
I don't know why you do that to begin with. That makes zero business sense to not set yourself up in that position to begin with. If I have a 50-50 chance of losing out on a deal, why am I wasting the time and energy to do that? That's stupid. Right. If I'm going to lose 50% of the time and also win, I mean, we'll relate this to trading. If I have a 50% win-loss ratio, my risk-reward of capital ratio better be extremely good. If you are going to run into 50-50 situations, you better know how to either make and add a lot of value. We'll use the real estate side. Make a lot of value out of a property and sell it for a lot, and know how to keep the bad properties at a very minimal loss on your books. Real estate, though, it's hard to do that. There's a lot of variables that go into that. And then that goes back to our conversation earlier. You have all these extra things that you're doing on top of it, that make the situation a little more challenging as well.
Yeah. So, well, I'm with you on this. And again, I like the development space in real estate, which is riskier, quote unquote, but I don't believe it is and again, how responsible are you with the debt that you use, for example?
Right.
The debt component in real estate is really where a source of a lot of risk that I think is mispriced, if we will, by a lot of syndicators. And guess what? In about the next 36, I would say probably even next 24, even 12, next 12 to 24 months, a lot of deals are going to hit the market that were not expecting, shall we say, the outcome that they've got. So,
oh yeah, and just waiting.
Yes. In fact, I sent a friend a cartoon of two vultures sitting on a telephone wire yesterday. If that gives you any indication of how I'm viewing the situation. Some people are like gnashing teeth. Oh no, it's a recession, and I'm like, A, I choose not to participate, and B, real estate's about to go on sale. Good, let's raise some capital.
Right, and I'm pretty sure I sent you my my hot take on the buying the real estate part at the dip, from my perspective of it, and everyone's saying they're looking forward to the big drop in real estate prices so they can scoop it all up. Yep. One, you don't know when the bottom is.
Right.
We'll start there. Two, if there is a serious drawdown in housing prices, it's most likely at the rate that we're going, it's going to coincide with job losses and unaffordable mortgage rates. You're not going to be able to scoop this up. It's not going to happen, at least at the lows. Will you catch it maybe 33% from the lows? Sure.
Yeah.
But you're not gonna catch it when it's at its lows. It just won't happen. As far as deployment of capital now, we'll stick with the risk side. You are running into a lot of risk. You have interest rate risk right now that's going on. They're going to keep raising rates. They're not going to stop until everything breaks and collapses. You already have Credit Suisse going under. I think their default swap, last I checked, their default swaps were up like 120 basis points in a day.
Oh man,
it's bad. But so, you're having to go out and get financing right now. You're having to take a loan probably in the 7 to 9 range, somewhere in there. I'd say fair. They're going to keep going up. So let's say you do start a project now. It's October. So it's October. So Douglas, how long does a traditional kind of facelift rehab
typically most value add bridge loans are 3 years with 2 1-year renewals is typically the time frame, and typically the turnaround is about 24 months is a good gauge generally.
No, but if I'm fixing so like if I bought a property, and I'm up, is that still 24 months, or is that like a 3-month kind of project where I fix it up and then I rent it back out?
Yeah, this is assuming a commercial multifamily property is what I'm talking about. So
okay.
like on a single family basis, typically 7 to 8 months on a single family flip.
Okay, so
is the range.
So say 100-unit apartment complex, right. It is going to.
It's closer to the 12 to 24.
12 4 months. So 12 to 24 months puts us in October of 2023 or October of 24.
Right.
Things are going to get very ugly between now and then. Even the people now who have existing properties that they've picked up within the last year or two, they're going to run into some huge problems. And I think what people weren't considering and taking into effect, and this goes to most real estate people not knowing much about economics, is whenever you print money, inflation happens. I think everyone knew it at some point, but no one really calculated the after effects of it, because we saw inflation start to run up, but we didn't really see any underlying effects to the economy. When this stuff happens, it lags. It takes time for it to get hit in, which is why, they started raising interest rates in March. We're really just now seeing the effects of, March, April, maybe May's interest rate hikes. It takes time for this data to catch up. It takes time for interest rates to catch up. We've only had 2 earnings cycles since they first started raising rates.
That's right.
It happened in December here as rates continue to go up. It's going to be this cycle. What happens next March when we're a year from the initial raise and earnings come out? There's all these kind of things to take into consideration. Now, as that happens, that removes a lot of capital and liquidity from many markets across the board. The long story short of it is there's a lot of job loss that happens. People then can't pay their rents. They can't pay your rent. You can't pay the loan obligation on your real estate portfolio because you thought the economy was great or everyone was paying it because they stimulus, all these other things. So you ran your risk parameters at 80 or 75% occupancy. You didn't think it could go any lower. We're in a recession. No one can pay rents. And now you're down at, say, 50%, 60% occupancy. Now we're 6 months into you not really making any payments on your loan, or at least making complete payments on your loan. So now they're foreclosing on you and taking your property away because you can't service this debt obligation. And what did you accomplish? So with that being said, how do you fix this risk? 1, get a fixed interest rate loan, for one, if you're going to do it. 2, if you were raising, if last year you were raising $10 million for a project, you need to be raising 50 to 70% more. Or let's say you were raising 20% of the total value of it, you really need to bump that up to about 35 to 40%.
Right. Well, and Dylan, I don't know if you've heard of Gerald Heinz or not. Gerald Heinz is like my hero real estate developer. Built a huge development firm in Houston, beginning in the 50s, and the history of boom and bust in Texas with oil boom and bust over that period of time was significant. I can think of at least two significant oil boom bust periods. Most developers got crushed, and he didn't. And the number one reason why Gerald Hines never lost a property is he always raised 50% equity to debt into his development deals. So
Absolutely.
again, debt is a significant source of risk in real estate, and I think we're about to have a PhD for some folks in that aspect.
Well, it's also you're hedging this risk internally. You need to. You should be doing it anyway. If you need 10 million, you should still be raising 12 anyways.
Right.
I would never stop at 10. There's you take on too much risk at that point. Someone could back out at any point.
Yep.
You make a contract, but if something happens, there's ways they can get their money back. So with that, say you needed to raise 10, you raise 12, you have 2 million in a float here. In case something goes wrong, you have a backup, you have extra cash to use. Best case, which is what you hope for, nothing happens, you don't need to use it. You can go use it on the next project. You've already raised capital for your next project by raising excess capital for this one.
I think you've just got to the mic drop moment, and here's what it is. Ladies and gentlemen of the real estate arena, I don't think, Dylan, I think it's a much more an equity thinking process. I haven't seen it a lot or not explicitly in any way, but conversation with real estate investors doesn't have the risk adjusted conversation. So what we're doing is your returns, yes, your returns on paper are going to be lower, yes, because you have additional equity. But what are you buying with the additional equity? Lower risk.
Yep, exactly. And I know I've been kind of bashing on real estate this entire time, but it's like you have to educate yourself. I see so many people just jump into this real estate game because they heard about it from a friend, or they saw it on an ad on YouTube, or they saw Grant Cardone 10x your life, whatever it may be.
Yeah.
And it's like you don't even know what you're doing.
Yeah.
You have no fundamental background of business or finance. You don't understand the risk parities of anything that's going on. Half of you aren't even compliant with anything. So you're gonna run into some issues, and you need to be prepared for them. The people who are doing stuff like this are the ones who lost all of their stuff in 2008.
Yeah.
Going, getting second and third mortgages, picking up 2-3 extra homes, doing all stuff on crap MBSs.
Yeah.
And I just don't think people. I know you and I have talked about this offline. I'm not going to say the word specifically, but real estate people, you guys need to start educating yourself more.
There you go.
You're lacking.
And again, welcome to my podcast. That is one of the number one reasons why I wanted to start a podcast. I know there are things in the equity world that if we applied in real estate world, we'd be much happier and a safer place. And I think that, Dylan, thank you so much for taking the time out to help me continue my mission of educating some folks on managing risk. And again, that's probably one of the number one things about my podcast that I'm hoping to add to the world in the educational space. And thank you so much, Dylan, for being on.
Absolutely, and thank you for having me on. I really appreciate it.
Good time as always, and I'm sure we'll continue this discussion moving forward.
Oh, I have no doubts.
All right, talk to you soon, my friend.
Yep. Bye.